US trade policy is a mess right now, and the Bank of Canada isn't falling for the trap of making bold one-liner predictions anymore. They've clearly learned their lesson from the whole rates will stay low fiasco during COVID. This time, instead of pretending they can call out how everything might unfold, they've laid out two possible scenarios to show how our economy could respond depending on how ugly things get with the US trade situation. Whether it's the more optimistic case or the worst case scenario, the growth forecast for 2025 and 2026 is actually lower than what they expected back in January. They are factoring in more risk and caution, and that's going to shape out how they're going to approach interest rates. So in this video, let's take a closer look at what Bank of Canada sees ahead for our Canadian economy. But before we dive in, if you're into real estate investing and you want straight up numbers-based advice, hit that like button, subscribe, and if you're serious about investing in Toronto multiplexes, book a call with us. Scenario one from the Bank of Canada is the less ugly option. Some US tariffs are rolled back, but not all. Trade policy stays unpredictable through 2026, and that uncertainty keeps both businesses and families cautious. People spend less, especially on big ticket items, investments slow down, and growth takes a hit globally and here in Canada. In this case, the Canadian dollar weakens and averages around 70 US cents during this period, just slightly weaker than it is today. Think of the scenario as a soft landing with turbulence. So in terms of GDP, the economy will stall briefly in the middle of 2025, so coming soon, then might pick up slightly, growing at around 1.6% through 2027. It's not great, but it's not a full recession either. On the inflation side, things might dip below 2% in 2025, mostly because the federal government cut the consumer carbon tax, which does lower energy prices. Inflation will then settle at around 2% from 2026 onwards, and we do see price spikes in non-essential goods because of Canadian tariffs on US imports, a weaker Canadian dollar, and businesses shifting to more expensive supply chains. But overall, inflation stays manageable. So in scenario one, what does this mean for real estate? Well, with inflation easing, the Bank of Canada does have more room to hold or even cut interest rates more, which could bring borrowing costs down. But do not expect a rush in buyers in this case still. People are still playing it safe and rent growth is slower than normal. And at the same time, new construction is slowing, so future potential supply is going to tighten. In this market, the smart move is to focus on cash flow and think long term. Buyers have more leverage right now in a buyer's market, and cash flow on Toronto multiplexes is stronger than it's been in over a decade. Long-term value still looks strong too. Real demand from end users, real demand from long-term renters, and with new future supply slowing down, the fundamentals for long-term growth in Toronto are stacking up. Now let's talk about Bank of Canada's scenario number two, the full-on trade war. In this case, the US doesn't stop at partial tariffs. They go all in. A global trade war erupts and tariffs become permanent. So global economic growth will slow down even more worldwide, and Canada takes a bigger hit. The Canadian dollar in this case will drop even further, averaging at around 67 US cents, much weaker than it is today. GDP shrinks for a full year, a true recession then, and then after that, the recovery will still be slow, with growth finally picking up to 1.8% by 2027. Inflation will end up swinging more in this scenario too. It might stay lower, close to 2% until early 2026, thanks to carbon tax cuts and weaker demand offsetting rising costs. But then it does spike above 3% by mid-2026, driven by tariffs and our weak loonie. And that is textbook stagflation, rising prices, but no real growth. If inflation stays high, the Bank of Canada might not be able to lower interest rates more, and we might even need to bump up interest rates a bit. and that will make our real estate market more unpredictable. So this is definitely not the time to be flipping properties. In a market like this, short-term wins can disappear pretty quickly. Long-term rentals can still work, but cash flows might get tighter if interest rates go up or operating costs go up. So if you are worried about rate swings, it might be smart to lock in a fixed mortgage rate right now and stick to strong real estate markets. We obviously like Toronto for a reason. It's got the jobs, the schools, the transit, and the steady demand. But really, no matter which way the economy goes, the real estate strategy today should focus on strong cash flow. Right now, cash flows in Toronto multiplexes are looking really, really good. Much better than any time within the past 10 years. And with yields in other investment classes coming down, this makes Toronto multiplexes a much more compelling choice. Now, even if property prices move up and down in the short term, many deals already make sense based on rent alone. And with real demand staying strong and new supply in the future shrinking, there's big long-term potential too. So if the numbers work today, you are in a great position for the future. And if you are looking for these kinds of opportunities in Toronto, that is exactly what we help with at Elevate Realty. We work with investors who want to make smart, data-backed decisions on multiplex properties in Toronto. Whether you want to invest in a turnkey investment or a value-add project, we'll help you find it and guide you through every step of the way. Here's what it's like to work with our team. We'll take the time to understand your goals, crunch the numbers to find you the best investment opportunities, and eventually help you land the right property. If you do want to dive into renovations, we can connect you with trusted contractors and guide you through the process. And once the work is done, we can even handle leasing and property management with you too. Ready to get started? Just head over to this link here and let's chat.